What's up, y'all? It's your boy Sham. Welcome back to another episode of the BJJ Lender, the podcast where we take principles from Brazilian Jiu-Jitsu and apply them to business, finance, and personal growth. Once again, it's your boy Sham. I'm a financial consultant and a purple belt in Jiu-Jitsu. Today, we're tackling an important financial decision that often confuses people. What's the difference between annuities and certificate of deposit, or CDs? Both are considered safe investments, but they serve very different purposes. Just like in Jiu-Jitsu, where certain positions are better suited for specific situations, annuities and CDs have unique advantages depending on your financial goals. By the end of this episode, you'll know the key differences between these two tools, including which one provides guaranteed monthly income, how annuities can help you avoid probate, and the death benefits they offer to your beneficiaries. So, with that being said, let's get into it, y'all. Let's start with the basics. What exactly are CDs and annuities? A CD, or a certificate of deposit, is a savings account offered by banks or credit unions. You deposit a lump sum of money, lock it in for a set period, anywhere from a few months to several years. And in return, you earn a fixed interest rate. At the end of the term, you get your original deposit back plus interest. It's simple, predictable, and safe. Now, an annuity is a contract you make with an insurance company. You either make a lump sum payment or a series of payments, and in return, the company guarantees to pay you income at a later date, typically during retirement. Annuities are also safe, but they offer a bit more flexibility in terms of how and when you receive payments, as well as some added benefits. We'll get into that later, though. In Jiu-Jitsu terms, think of CDs as a basic guard, your close guard, reliable but limited in scope. Annuities are more like an advanced position. You still have security, but you have more options to transition and set up future moves. One of the biggest advantages of annuities over CDs is guaranteed monthly income. When you invest in an annuity, you're essentially setting yourself up for a consistent paycheck in the future, especially during retirement. An annuity can be structured to pay you income every month, quarter, or year for a set number of years, or even for the rest of your life. This is a game changer when compared to CDs, where you receive a lump sum at the end of a term but don't have an ongoing source of income. For people who want financial stability in retirement, annuities offer a peace of mind. It's like knowing you have a go-to technique in BJJ that you can rely on every time. Whether the markets go up or down, whether interest rates fluctuate, you'll still receive your monthly payout. This can be especially valuable if you don't have a traditional pension, or a Social Security won't be enough to cover your living expenses in retirement. CDs, on the other hand, provide interest payments that are usually paid out annually or at maturity. While this is safe and predictable, it doesn't offer the same long-term security that an annuity does in terms of regular ongoing income. With the CD, you might have to worry about reinvesting the principal when the term ends, which could expose you to changing interest rates or a lack of reliable income flow. Another big win for annuities is that they can help you avoid probate, a legal process that occurs after someone passes away. And if you have ever lost someone close to you, like your boy, and had to deal with probate, I'll bet you were willing to do anything you can do to avoid it again in the future. Yeah. When you leave assets in a CD or a traditional savings account, those funds often have to go through probate before they can be distributed to your beneficiaries. This can be a long and costly process, delaying your family's access to your assets. Annuities, however, offer a major advantage in this area. If you designate a beneficiary on your annuity contract, the money in the annuity typically bypasses probate entirely. This means your beneficiaries can receive the funds much faster without the hassle and expense of going through the court system. It's like securing a dominant position in BJJ. You're in control, and there's less chance of your opponents, or in this case, creditors or legal fees, interfering. For anyone who wants to make sure their loved ones are financially secure after they're gone, this is a significant advantage. With CDs, your heirs could be waiting months or even years before they can access the funds. With annuities, the process is much smoother, ensuring a faster transfer of wealth. Annuities don't just help you avoid probate, they also come with built-in death benefits for your beneficiaries. If you pass away before your annuity payouts begin, or even after they started, your beneficiaries can still receive either the remaining payments or a lump sum, depending on how the annuity is structured. Let's break it down, y'all. If you have a life annuity with a death benefit rider, your beneficiaries are guaranteed to receive a certain amount, even if you don't live long enough to collect all the payments. Some annuities even offer a feature called a refund option. A refund option is where the insurance company will pay your heirs the remaining value of your account if you pass away early. It's like setting up a submission in JITS. If one approach doesn't work, you still have a backup plan to secure the dub. CDs, on the other hand, typically don't offer these kinds of protections. If you pass away, your heirs will simply receive whatever is left in the account at that time. There's no additional benefit beyond the principal and interest that have accumulated. While this is still helpful, it doesn't offer the same level of financial protection that annuities provide. Now, let's talk about interest rates, y'all. CDs generally offer fixed interest rates for the duration of the term, which means your money is growing at a predictable rate. However, CD rates are often lower than the potential returns you could get from a variable annuity or a fixed annuity even, which is tied to the performance of the stock market or other investments. That's a VA, y'all, not to get confused. It's important to note the average interest rate of a CD over the past 5 years is 1.8%. Then that over time won't grow too much more than your original investment. 1.8%. That said, annuities also come with fixed rate options, which are comparable to CDs, but often have the added benefits we just talked about, like monthly income and death benefits. It's also important to consider that any CD interest is taxed as ordinary income, which means it can push you into a higher tax bracket depending on your total earnings for the year. However, one thing to keep in mind is that annuities can have fees, such as administrative costs or surrender charges if you withdraw your money early. It's important to note here that the average rate of return on annuities over the past 5 years has been around 8.8%. See the difference in fiscal growth between the two vehicles? In jiu-jitsu terms, think of CDs as playing it safe. Keep in control, but not pushing too hard for the sub. Annuities give you more flexibility, but you need to be aware of the risks and fees, just like transitioning between different guard positions. Sometimes it opens up new opportunities, but it can also expose you to risks. So, which is right for you, annuities or CDs? It really depends on your financial goals and where you're at in life. If you're looking for a safe, short-term investment with no fees, a CD might be the way to go. But if you want guaranteed income in retirement, want to protect your heirs from probate and provide death benefits, then an annuity is a better choice. For those approaching or already in retirement, annuities can be an excellent tool for creating reliable income stream, while also providing protection for your loved ones. Younger investors might lean towards CDs or other short-term investments for liquidity and flexibility. But as you get closer to retirement, y'all, an annuity can serve as a financial guard, defending you from uncertainty and ensuring your family's security. All right, let's wrap things up. Both CDs and annuities have their place in a well-rounded financial plan. CDs offer safety and simplicity, while annuities provide long-term security, guaranteed income, and protection for your beneficiaries. As always, the key is to know your goals and work with a financial professional who can help you make the best choice for your situation. You can visit our website at forward2strategicsolutions.com to learn more about our services or drop us a line on social media, YouTube, TikTok, Instagram. My handle's still the same, y'all, the BJJ Lender. Thanks for joining me on this episode of the BJJ Lender. Remember, whether you're on the mats or managing your finances, it's all about being prepared and making the right moves at the right time. Until next time, stay sharp, stay disciplined, stay rolling and flowing, and building your financial foundation. It's your boy Sham, logging out.